Did you know that the IRS actually encourages people to invest into real estate and they offer tremendous tax savings in return? Here is an actual recording of my accountant telling me exactly how much I would get back in a tax refund in 2023.
Then your federal refund would be $20,000, and your state refund would be another $19,000.
Because I had invested in real estate. Would you like some more proof? Here is an actual Schedule E form that the IRS created themselves. Notice one thing. There are actually 15 whole lines on here that a real estate investor can use to take deductions against their rental income. If I was just an observer, I would say that the IRS is literally rolling out the red carpet for real estate investors. Hi, my name is Ryan Chaw, your friendly neighborhood real estate investor, and I show new investors how to get their first investment property. Quick disclaimer before we begin, I'm not an accountant or CPA, and so none of this should be taken as tax or financial advice. And I recommend that you discuss your personal tax situation with your CPA because everyone's situation is unique. Now, as a real estate investor, there are actually 3 specific ways that you can reduce your taxes, and one way where you can actually bring your total taxes down to nearly $0 while still working a high-income W-2 job. In this video, I'm going to show you what those 3 ways are, as well as sneaky IRS rules to know and pitfalls to avoid so that you don't end up with a costly tax penalty down the road. Now, the first way you get to pay less taxes as a real estate investor is by using a method called taking tax deductions. A tax deduction reduces the amount of your income that's subject to taxes. How deductions work is that instead of being taxed on your income and then paying your expenses based off of whatever is left over, like most normal people, as a real estate investor, you get to deduct your expenses from your income first, and then you get taxed on whatever is left after those expenses. Subtle difference, I know, but it's very powerful in building your wealth over time. For example, take a look at the screen. On the left side is a normal employee who doesn't own rentals. And on the right side is somebody who works but also has rentals that they manage. On the left side, you're taxed on your W-2 income. Let's say it's a 35% tax rate. That means you're left with $65,000 after the taxes. And from the $65,000, you're also deducting out your expenses of $20,000, which leaves you with $45,000. On the right side, it's pretty similar, except that you're deducting out your expenses first from your income. So if the expenses are, again, $20,000, you're left with $80,000. And from there, that's when you're taxed at the 35% tax rate, which leaves you with $52,000. You can see that being taxed after you pay your expenses allows you to save $7,000, assuming the same income, the same expenses, and the same tax rate. You would also be surprised that most new real estate investors are not taking all the deductions that they should be taking and therefore are leaving a lot of their money on the table. For example, let's say you set up a home office and you use that space primarily to manage your rentals. Well, as of June 2024, you may be able to deduct $1,500 from your income using the home office deduction per year. You also get to deduct anything that is considered ordinary and necessary for you to run your rental business. For example, in order to contact your contractors, tenants, and real estate agents, you need access to a phone, internet, and your email. Therefore, a portion of your actual phone bill, internet bill, and computer costs can be taken as deductions against your rental income if you use them in your business. Now, let's say that you visit your rentals that are in a different city that you live in. You probably need to fly over there, and therefore your flight, hotel stay, and a portion of your meals will also be deductible. And if you decide to explore the city after you're done managing your rentals, you get to mix in some vacation time where your business essentially covers your travel costs for your vacation/business trip. To make things even crazier, you can deduct money that doesn't actually exist in real estate investing without having to print out counterfeit dollar bills. How the heck do you do that? Through a special deduction that you can take on any rental called depreciation. Depreciation is the imagined wear and tear on a house. Even though that we all know that houses go up in value, Depreciation is assuming they go down in value, and therefore you get money back for that assumption every single year. To calculate your depreciation, you first subtract out your land value from the purchase price on the property. For example, here is one of the properties I bought for $535,000. I divide the assessed property value of $158,400 from the total assessed value of the land plus the property, which is $199,400. This gives me 79.4%. That's allocated towards the building value and not the land value. I then multiply this percentage by my actual purchase price of $535,000. This gives me $424,790. For residential real estate, the property's useful life per the IRS is 27.5 years. So I divide my building value of $424,790 by 27.5 years. This gives me about $15,400 per year. And that means that I don't need to pay taxes on my first $15,400 in profit on this property. And I get this every single year. You can imagine just having 10 of these properties means you get to deduct $154,000 every single year. And that's just from depreciation alone. Now, I have some good news and some bad news. All of the deductions that I mentioned so far can be deducted against your rental income. However, you can usually only deduct up to $25,000 from your primary W-2 income if your adjusted gross income is $150,000 or less. However, this completely changes if you meet one classification, which I will explain. The IRS has some rules called the passive activity loss rules, which state that owning a rental is a passive activity and therefore produces passive losses, and passive losses can only be deducted from passive income. As you can see on your right side, you have your passive income, aka rental income, and your passive losses that can be deducted from it. On the left side, you see your active income, aka your W-2 income. Now, there's a huge exception to these passive activity loss rules, called real estate professional status, which is the second way to save money on taxes. If you or your spouse is considered a real estate professional, then your rentals are automatically converted to active losses and therefore can be deducted from your W-2 active income. I'll repeat this again. Real estate professional status allows you to convert passive losses into active losses. I took this deduction in 2023 when I retired as a pharmacist and did full-time real estate investing. You can see my tax bill here where I made $108,000 as a pharmacist, another $150,000 in capital gains selling one of my properties, and much more in rental income. Yet my tax bracket is 0% for federal, and I have an effective tax rate of 4.6% living in California. So, am I cheating or doing something illegal? No, I'm actually able to do this because I meet the 3 criteria for real estate professional status. The first criteria is that you need to spend 750 hours per year, which is an average of 14.5 hours per week on your real estate business. The second criteria is you need to spend more time in your real estate business than your other work occupations. Finally, the third criteria is that you need to meet 1 out of 7 material participation tests in each real estate business that you manage. Now, the great news is that if you're married, your spouse can meet the criteria and you also still get the benefits. I was able to meet this criteria because I personally spent over 750 hours in my real estate business and much more. In order to do this, I kept minute by minute Zoom logs and phone logs of all the time that I spent on real estate activities. It wasn't that hard though. I just had to download the data. Though I worked part-time as a pharmacist, my other hours were spent investing in real estate and managing the rentals. And the best part, my CPA told me by achieving real estate professional status, I receive a $39,000 tax refund, versus if I wasn't a real estate professional status, then I would owe the IRS $8,000. So I saved a total of $47,000 in taxes in 2023 by being a real estate professional. Now finally, the third way to reduce your tax bill by investing in real estate is by continually reinvesting your money and equity. Let's say your property goes up in value by $100,000. Bank lenders will allow you to borrow out that money using a home equity line of credit, also known as a HELOC. or do a cash out refinance. Because you're borrowing against your own money and equity as debt, it isn't taxed. I had used this method personally when my first property went up $200,000 and I borrowed out that money to make a down payment on my fourth and fifth properties. The famous Robert Kiyosaki, who wrote Rich Dad Poor Dad, used this method to pay no taxes on his huge portfolio where he was $1 billion in debt, yet he has a net worth of well over $100 million. Now, the best part of real estate investing is that when you sell a property off and reinvest the gains into another property, you aren't taxed on the capital gains as long as you do what we call a 1031 exchange. A 1031 exchange is a way that you can defer your capital gains literally forever on your rental portfolio by buying larger and larger rental properties. The best part of this, even when you die, you don't need to pay your capital gains taxes because it passes on to your children in a step-up basis, which exempts them from paying capital gains taxes on property that's held until death. Remember that everyone's tax situation is different, so please discuss your personal finance situation with your CPA. And this video isn't to be interpreted as financial advice. If you found this video helpful, please give it a thumbs up, subscribe, and share it with your friends so that I can reach more people who are really struggling with real estate investing. Thank you for watching, and I'll see you on the next video.